Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
When you think about the business life cycle, everyone focuses on, the heroic act of the founding, the scaling, the innovation. But the truth is, the most complicated, stressful, and defining moment for an owner is often the exit.
It absolutely is.
Starting a business is hard, but exiting that business successfully, profitably, and on your own terms, that can be even more challenging. It's just an incredible life-changing milestone.
It is. And when you look at the lower middle market, which is really the focus of our deep dive today, that decision is especially profound.
Okay, what do we mean by lower middle market?
So we're talking about businesses typically ranging from, say, $10 million to $100 million in enterprise value. For these founders, this isn't just a transaction.
It's their life's work.
It's the culmination of decades of work, and often their entire personal net worth is tied up in it.
That distinction is so crucial. It means the stakes are intensely personal. So today we are taking a deep dive into the intricacies of the M&A sell-side process, specifically for this LMM segment. And our structure for this is built around some really detailed, real-world M&A insights, largely drawn from the expertise of Charter Capital Partners and Emily Davis.
Our mission today is pretty simple. We want to map out the four-phase journey any LMM business owner can expect. It's about providing a clear framework to reduce that uncertainty.
Right.
We want you to understand the strategic decisions you'd have to make right now, long before a buyer ever even looks at your books.
And what's that journey?
It's preparation, then initial marketing, followed by presentations and vetting, and finally the big one, closing.
Okay, let's unpack that first strategic choice, the decision to sell. Our sources really emphasize this is never a snap judgment.
No, not at all. It's a confluence of things. You've got the macroeconomic realities, company-specific variables, and above all, what the shareholders actually want to achieve.
And once that decision is locked in, the very first step is getting expert advisors, specifically investment bankers.
This might sound obvious, but this is probably the most critical risk mitigation step an owner can take.
Wait, risk mitigation? I thought the main role of the investment banker was just to get the highest price.
That's a core function. For sure, but the deeper value is managing the inevitable disruption. When a sale process begins, it just sucks all the air out of the room. Management needs to be focused on running the business, because if performance dips during the sale,
The price drops.
the purchase price will drop, and the buyer will use it as leverage. The banking team staffs the transaction, they absorb that workload, and they let management keep their eye on the ball.
That makes perfect sense.
Yeah.
So once the advisors are in place, how do they translate the complexity of a business into something marketable? That's the kickoff meeting, right?
That's the starting gun, yeah. This preliminary due diligence session is often an intense all-day Q&A. The deal team needs to understand the company inside and out.
Not just the numbers.
Not just the numbers, the general operations, the legal structure, sure, but also the qualitative side. They're asking probing questions like, what is this company's unique value proposition? Or who are the key customers you absolutely cannot lose?
So they're basically taking the messy reality of the business and distilling it into a compelling narrative, a story that highlights the growth potential.
Precisely. And that narrative forms the basis of the key marketing deliverables. So first you have the teaser. It's short, it's blinded.
Meaning no company name.
No company name. It's designed just to pique a potential buyer's interest.
Okay, and then you step it up with the Confidential Information Memorandum, the CIM.
Right, this is the primary sales document. It's extensive, often 50 pages or more, detailing everything, operations, financials, the management team, all of it.
And then there's the presentation deck.
The management presentation, or MP, which is the visual guide the owner will eventually use. But all the raw proof, The contracts, employee records, all the sensitive spreadsheets, that goes into a secure online virtual data room, the VDR.
I imagine the VDR isn't just some messy Dropbox folder. Is the organization of that data room strategically important?
Absolutely vital. A messy VDR suggests a sloppy business. It raises immediate red flags and guarantees friction later on.
I see.
The banking team ensures that data organized neatly into corporate, financial, legal, HR folders is basically audit ready. A perfectly structured VDR signals efficiency and confidence.
And that confidence translates directly into a better offer.
It does. Now, once all those documents are ready, the bank essentially brokers a staged, professionalized auction. The goal isn't just to sell, but to establish true market value by creating competitive tension.
Competition sounds great, but it probably comes at a cost, right? Especially for an LMM owner who values their privacy.
It does. So our sources compare two primary strategies. The first is the targeted marketing strategy, sometimes called fireside chats.
Fireside chats. I like that. What does it mean?
It means you're targeting maybe 2 to 5 highly qualified known buyers. The timeline is fast, typically less than 5 months.
The benefit there seems obvious. Maximum confidentiality, minimal disruption, and maybe you find a true cultural partner. What's the downside?
The downside is less negotiating leverage. When you only have 2 buyers at the table, they know it. There's a real risk you might leave money on the table.
Because you are running a full market process.
Exactly. You're prioritizing speed and secrecy over, well, price maximization.
Which brings us to the other option, the broad marketing strategy.
Right. This is targeting 5 to 50 or even more buyers. It's a full contact sport running 5 to 7 months, sometimes longer.
And the goal here is pretty simple. Get the highest price possible.
That's it. When you have 50 buyers competing, the market sets the price. It gives the seller the strongest possible negotiating leverage, but the trade-offs are significant.
More time, more disruption.
And maintaining confidentiality across dozens of interested parties becomes extremely difficult.
So that's really the owner's first major dilemma. Do you want the top dollar or do you want a quiet, speedy exit?
That's the core question. And once that strategy is set, the bank uses tools like S&P Cap IQ or PitchBook to vet the buyer universe. And they're looking for 3 main types of buyers.
Yeah, okay, who are they?
First, the strategic buyers. These are other companies in your industry, operationally similar businesses.
I imagine they can offer the highest price because they see direct synergies, right? They can cut costs or merge sales teams.
Correct. They often offer the highest synergy premium. But here's the catch. They move so much slower.
Why is that?
They have their own operations, quarterly earnings reports, layers of corporate bureaucracy. They aren't a dedicated deal machine like a private equity firm.
Okay, so who's next?
Second, you have strategic financial buyers. These are private equity firms that already own a company in your industry. And third, the pure financial buyers.
Just a PE firm that likes the industry and the size?
Exactly. They tend to offer the fastest timeline and immediate access to growth capital. They are transaction specialists. This is what they do all day.
So it sounds like the winning buyer is rarely just the one with the highest check. It's about the best combination of price, speed, and cultural fit.
For LMM owners especially, that non-monetary factor, the legacy, protecting their employees, that's often the ultimate tiebreaker.
All right, now the business is officially in market. This kicks off phase 2, initial buyer marketing.
Yep. The bank sends out that mass email with the blinded teaser and a confidentiality agreement, a CA.
And buyers have to sign that legally binding CA before they get the full story, the big CIM document. So that's the first hurdle.
It's the first filter to weed out the people who are just curious. After getting the CIM, qualified buyers analyze the materials, they get on calls with the deal team, and this leads to the first round of bids, the indication of interest, or IOI.
And this is non-binding, right? A preliminary offer?
Fully non-binding.
So what makes a good IOI? I assume they can't just throw out a high number and hope for the best.
Absolutely not. A solid IOI has to include a specific purchase price range to show they've done real work, all their material assumptions, details on financing, and a proposed timeline. This is where the bank starts weeding out the tire kickers.
And that's where the real vetting begins. Yeah. What are you looking for beyond just the price?
The depth of work. The total enterprise value is crucial, of course, but the deal team is also looking at the quality and detail of the buyer's analysis. Did they do their research? Do they really understand the risks?
So a buyer who just submits a high number with vague assumptions is a red flag.
A huge red flag. It signals they'll probably try to retrade the price later or that the deal will just fail in due diligence.
Okay, so only the top 5 to 10 bidders survive that cut, and they move into phase 3. Management presentations.
These are serious day-long business sessions, often paired with an informal dinner the night before.
And I bet that dinner is almost as important as the meeting itself.
It really is. It's the human element. The owner is meeting the people they might be partnering with for the next 5 years. Then, in the meeting, the CEO, CFO, COO present that detailed management presentation.
And the goal here is genuine interaction, not just a lecture.
It needs to be conversational. This is also when facility tours happen, visiting offices, warehouses, whatever it is.
And at the same time, these buyers are getting deep access to the VDR, the virtual data room.
Correct. This is the time for deep inspection. Buyers bring in their own experts, accountants, attorneys, consultants to stress test every piece of company data. They're hunting for risks and validating those synergies.
I imagine this is where a lot of deals can start to fall apart if the prep work wasn't solid. What's the biggest headache in this VDR review phase?
Unanticipated liabilities. If a buyer's accountant finds a big problem with how revenue was recognized, or an attorney finds an undisclosed lawsuit, trust just evaporates instantly.
And the deal's dead.
Or at the very least, in serious trouble. The bank's job is to manage that whole Q&A flow and hopefully find those bombshells before the buyer does.
Okay, so we've survived the presentations and the initial due diligence. Now we're down to the final bidding round.
We are. The remaining top buyers receive the letter of intent, LOI process letter. This is where the commitment gets very real.
The LOI sounds far more stringent than that initial IOI. It's shifting from a range of interest to a specific proposal.
That's the key distinction. Buyers have to include the exact total enterprise value. No more ranges. Confirm the target working capital and provide detailed plans for management post-close.
Let's pause on target working capital. Why is that specific detail so critical in an LOI?
Because working capital is the operating cash needed to run the business day-to-day. If a buyer pays a huge price, but the owner sweeps all the cash out right before closing,
They're left with an empty shell that can't make payroll.
exactly. The LOI sets a baseline amount of working capital that has to be in the business at closing. It protects the buyer and ensures the business keeps running smoothly.
Okay, so once those final LOIs are in, the negotiation starts. And the advice is to negotiate 2 or more LOIs if possible. Why keep that competition going right to the very end?
It creates immense pressure. Having a second viable LOI on the table gives the seller maximum leverage to push the primary bidder on crucial points, like improving the price or shortening the exclusivity period.
Once the seller picks the winner and signs that LOI, the buyer gets a period of 30 to 90 days of exclusivity. This sounds like the final high-stakes stage.
This is where most deals die. The exclusivity period is for the buyer to finalize their last bits of due diligence, get their financing locked in, and draft the definitive purchase agreement.
What are the top reasons a deal falls apart here in this exclusivity window?
Financing failure is a common one, but more often it's something discovered deep in the VDR that wasn't visible before, a hidden tax liability, a major customer about to leave.
And then the buyer tries to retrade the price or just walks away.
That's the risk. The owner has to manage the process rigidly to make sure no new information comes out that could derail the deal.
Assuming they navigate that successfully, we reach closing day. The goal is a simultaneous sign and close.
That requires absolute flawless organization. M&A legal counsel really takes the lead here, making sure every single document is perfectly finalized.
The ultimate finale is a final call where everyone confirms due diligence is done, the legal docs are good, and the signature pages are released.
And then the moment of truth. The buyer releases the wires. That confirmation, the funds hitting the accounts, that officially signifies the transaction is closed. It's a process defined by precision, strategy, and immense focus.
That 4-phase structure: preparation, marketing, vetting, and closing is really the framework that guides an LMM business exit. For you, the learner, I think the key takeaway is that this process is professionalized. It's a highly structured, competitive auction.
It is, and surrounding yourself with experienced expert advisors is just essential to navigating it with integrity and, actually meeting those shareholder expectations.
We've reinforced those crucial early decisions you would face. especially that choice between maximizing price in a broad auction or prioritizing speed and confidentiality with a targeted one.
And that choice is based entirely on your specific objectives.
The sources are really clear. The most challenging part is taking that first step, moving past the emotion and into the strategic endeavor. Knowing the pathway is defined, while complex, it transforms the decision from a mystery into a manageable project.
So reflect on this, and this is your final thought. If you were the owner of an LMM business embarking on this journey, what would your single non-negotiable objective be? Is it maximum financial value, requiring that messy, competitive effort?
Is it the fastest possible closing time? Or is it finding the best cultural partner for your legacy? Even if they don't offer the absolute highest price, that one decision defines the entire outcome.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.